Shares popping after possibly optimism from New York City. For our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Ferro, 30 minutes away from the start of trading, and you can see NASDAQ leading the pack as we prepare for what could be a disinflationary kind of relief. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
Coming up, inflation in America showing signs of cooling off, giving the Fed room to pause as debt ceiling negotiations go nowhere. We begin with the big issue, another pivotal piece of economic data.
In the US, we've got inflation coming out today.
A lot of the details really do matter here.
Inflation is the big problem.
We're really looking at those core non-shelter services in this report.
When it comes to the CPI report, it's all about core services.
It really does just come down to the stickiness of core services inflation.
Especially outside of shelter, things like recreation, things like consumer spending.
And that's the inflation that's worrying for the Fed.
They have said that they're very data dependent.
Reiterated that they're going to be data dependent from here.
A lot of market participants really expect and want to see slowing in the economy.
A lot of the inflation data, I think it gets a bit more nuanced now.
And that is what you're hearing from a lot of people as they parse through the data, including Bloomberg's own Michael McKee joining us now. Mike, what's the latest from your read of the granularity of this report?
Well, the headline numbers come in basically as expected, Lisa, with both core and the headline numbers up 0.4% on the month for April. It's in the year-over-year numbers that we see a little bit of improvement, with CPI headline falling to 4.9%, which is a little bit of good news, I suppose. On a year-over-year basis, the core falls to 5.5%, so that is good news as well. But it's the core services ex-housing. You heard a couple of the economists in that shot string there talking about that we really see some good news, and that is when you take housing out of the services side of it, this is Jay Powell's favorite indicator, we see a decline from 0.27 to from 0.29 to 0.27 on a month-over-month basis, but a fairly hefty over 50 basis point drop in the year-over-year number, and so it does show some progress being made. What moved during the month? Well, the rent of primary residence. The rent numbers are still holding up housing, up 0.6%. That was after 0.5 last month. Gasoline was up. You probably know that if you fill your tank, 3%. Used cars, breaking a string of 9 months of declines, up 4.4%. Now that may revert next month. Services overall up 0.4, and that's where the Fed is still concerned about seeing inflation as companies raise prices to keep up with their higher costs of labor. So, Lisa, this comes in about as expected overall. Economists pretty much nailed it, but we are still seeing 2 rate cuts priced in starting in the middle of the year. And I'm glad you have some experts on to tell us.
Michael McKee, you are bringing us exactly where we want to go. Thank you so much, as always, for the incredible insight. And it is exactly that. You can give the data, but then give what the market response is, and perhaps you get a sense of where the bias is in terms of people looking for some excuse for the Fed to move away from the tightening cycle. Joining us now to discuss just that is Citigroup's Angie Hollenhorst and Neuberger Berman's Eric Knudsen. Andrew, I want to start with you. The relief that we're seeing in markets, what do you make of it at a time when inflation is still hot and yet it is cooling, and quite clearly?
Yeah, it's interesting, Lisa. So I think coming into this report, there were maybe some heightened expectations in markets that we were going to get a really outsized increase in core inflation, which would point very strongly to the Fed needing to hike again in June. Instead, where this report leaves us is very consistent with expectations. I mean, came in almost exactly where we expected it to come in. And that just keeps the Fed in a really uncomfortable position where you have financial stability risks on one hand. On the other hand, though, I think we should be emphasizing, yes, we can talk about the details of the report, but this was a 5th consecutive month of month-on-month inflation that annualizes to something around 5%. So we're just stuck at 5% underlying inflation. There's nothing in the labor market that would tell you this is going to cool down. So yeah, markets today, I think maybe expecting something a little bit stronger, and relative to those expectations, we're getting a reaction. But the overall economic message should be we are stuck at inflation that is more than twice the Fed's 2% target.
Eric, what's your view on that? Basically, the push-pull of a Fed that is stuck between financial stability and inflation that, even though it is cooling, is still well above where they want it to be.
Yeah, I think that as many of your commentators said in the lead-in, this is what data dependent looks like. It means reacting to every print, both markets and now policymakers. And so we risk being Milton Friedman's proverbial fool in the shower, where the Fed risks, or certainly market participants risk, just reacting to the latest number and not keeping an eye on what the long-term trends and what the long-term outcomes need to be. This is a decent number in line with the kind of forecast, and it's not surprising that markets are kind of jumping on this, but it doesn't, it's not a kind of declare victory number, as I was talking about with members of my team already this morning. This is still going to keep the Fed, kind of focused on what they need to do. Policy rates now have gone into positive territory on a real basis for the first time in years, just barely. The Fed is going to need to keep on doing that to get inflation down towards target, and above these still pretty high levels.
Eric, is your sense that the optimism that we're seeing baked into stocks as a result of possibly a pause from the Fed is warranted?
We don't think so over a 6 to 18 month time horizon, but we also wouldn't be surprised if you see some, positive movement in equities from here, because the underlying fundamentals, you just saw better than expected earnings. You've got 3.4% unemployment. You've still got a robust consumer. And so you could see some upward pressure on equities in the short term, almost relief from some of these concerns. And yet, over a 6 to 18 month time horizon, we don't see the kind of valuations we see warranted. We think there will be further downward pressure on equity prices given the tightening that we see in the system, stickier inflation, and more tightening likely to come when you think about the impact of banks and withdrawal of liquidity.
Andrew, a lot of people probably push back against the message that you've been putting out there, which has been pretty consistent, simply that we are going to see a Fed that is on hold for a lot longer than people previously thought, and this flies in the face of a lot of the optimism that we've been seeing. So how do you push back against people today who come out, including Bill Dudley, formerly of the New York Fed, saying that we're going to get inflation down to 3% by the end of this year, and this isn't even including some of the house price declines that are not factoring in to the same degree in this report as the next one? How do you push back and say, no, this is a stickier and longer lasting inflation that requires a fight?
Yeah, I think Eric said two things that are really important. One is, what is the underlying economic trend? What is driving this inflation? We've moved to a services-based inflation. This is being driven in part by labor costs that are rising rapidly. The underlying trend, the underlying dynamic is a very tight labor market that's pushing up prices. So, I don't think that we're going to see 3% core inflation this year, core PCE at least. That will probably stay north of 4%. And then the other thing that Eric mentioned, policy rates on a real basis, we're running, around 5% inflation. We just got policy rates above 5%. Typically, to bring down inflation, you need nominal policy rates to go above the rate of inflation. We're maybe just getting there now. So I would just be really cautious about concluding that the Fed can start thinking about cutting here when really the balance of risks are towards hiking further.
Andrew, why then are people still pricing rate cuts into the market?
Well, this is the difficulty because we know we have these financial stability risks, and these are non-linear risks around the banking sector. If you have a flare-up in financial stability issues, and of course we had one in March, the initial deposit issue really does look quite contained. I think we saw some of that in the senior loan officer survey. We see that in the data that we get every week on bank deposits. But if we have this kind of generalized concern about the banking sector, that could become a very significant downside risk. That could lead the Fed to cut. So you have to have some probability afforded to that. I think the market is doing that. What the market is probably missing here is that, again, inflation is just stuck at too high a level. I mean, it's really, I would agree with Eric, it's just hard to look at this number and think that the Fed is going to see anything here that tells them that they're on that path to 2%.
Eric, I was struck by something that Ira Jersey of Bloomberg Intelligence wrote, basically saying that CPI has been one of the most traded events of any potential data that's been coming out How do you look at this in terms of a trading moment, in terms of an asset allocation perspective? Do you trade off this? Do you adjust your expectations, or do you just basically use that in sort of the sort of metric of longer term investing?
So, most of the time, and most of our risk is going to be taken with a longer term horizon, say 6 to 18 months, and trying to achieve clients' goals over a much longer term using, just strategic asset allocation, capturing long term exposures. And that gives us an edge because, especially in environments like this, where markets are trading every single data point and you see massive day-to-day volatility off of the latest print, often, reversing what happened the day before. We actually think that we have an advantage for our clients in terms of looking a little bit longer term through that. That being said, there are ways to take advantage of some of the shorter term movements, say in volatility markets, where you can take advantage of differences between, say, equity volatility, which is very low, considering everything, and is consistent with long-term Treasury volatility. And you compare that to, say, 2-year Treasury volatility, which is extraordinarily high, and that maps to underlying sector volatility. So trying to take advantage of some of the distortions and discrepancies that in volatility terms, for example, and being able to position portfolios to take advantage of that in the shorter term can create some interesting opportunities in a very kind of day-to-day, data-driven market.
Just quickly, Eric, does that mean that you're betting that volatility in stocks is going to go up, or that volatility in bonds is going to go down, or both?
More that volatility in the 2-year Treasury has to come down through time. That's how things are likely to normalize. I think people have been betting that, equity volatility has to go up. Well, equity volatility is very high if you look sector to sector, security to security. It's just not at the index level because there's not much going on there, or so it appears at the index level. And so, one of our key views from our fixed income team is that fixed income volatility has to come down before equity markets can heal. And that's what we expect to happen over the course of the coming 6 to 12 months.
Eric Knudsen, Andrew Hollenhorst, both of you are sticking with us. Let's get a look now at some of the stocks that are moving just ahead here of the opening bell. Abigail Doolittle has those. Abby.
Hey, Lisa. Well, it's interesting because we, of course, do have the futures popping higher after that CPI print, but we do have one big laggard to take a look at. In fact, I think that this may be the worst day for Airbnb in its young life since IPOing back in December of 2020. Shares are plunging, down 13%. The first quarter report was strong, but a muted outlook has these shares lower. Forward growth is moderating. Plus, one analyst is saying that there's clear competition from Booking. Occidental Petroleum also reported its first quarter. Shares are down about 1%. There was an earnings and a sales miss. However, production guide, it is slightly above the previous guide. So let's see how this day shakes out. And then finally, we've had a bit of a turnaround for PacWest, the beleaguered regional bank. It is up 5% after having been lower in the pre-market. This pop happened after that CPI print. Since last week's low of $2.48, Lisa, the stock is up nearly 150%.
Thank you so much, Abigail. Coming up, back to square one.
Everybody in this meeting reiterated the positions they were at. I didn't see any new movement.
We agreed to continue our discussions, and we're going to meet again on Friday.
And we're getting more of this, and we get another meeting and another one. President Biden and Speaker McCarthy making little progress on Capitol Hill. They will try again. That conversation coming up next.
Everybody in this meeting reiterated the positions they were at. I didn't see any new movement.
Speaker McCarthy offered a very different way forward.
Instead of him giving us a plan to remove default, he gave us a plan to take default hostage. And that is a shame.
The United States is not going to default. It never has, and it never will.
We explicitly asked Speaker McCarthy, would he take default off the table? He refused.
I was very clear with the president. We have now just 2 weeks to go.
We agreed to continue our discussions, and we're going to meet again on Friday.
Debt ceiling negotiations yielding little progress in Capitol Hill. Republicans unwavering in their push for federal spending cuts. Democrats refusing to compromise with a default on the table. The two sides committing to daily talks, preparing for another meeting on Friday, with Secretary Yellen's ex-date now just 3 weeks away. For more, Bloomberg's Kayleigh Lyons joining us now from Capitol Hill. What progress could be made on Friday, or is this going to be a can-kicking exercise until the 11th hour, the 59th minute, and the 59th second?
It's a really good question, Lisa. Obviously, if there was good news to come of yesterday's meeting in which there was little tangible progress, it was this idea that the two sides are going to continue talking. Beginning today, aides from both the White House and congressional leadership will begin those conversations, of course, leading up to that meeting that is taking place again between these five on Friday. But as we just heard from the congressional leaders themselves and from the president, there wasn't that much budging on either side. Of course, the president has said that he is willing to negotiate over the budget. He still wants a clean debt ceiling raise. So really what this comes down to is whether or not there is a compromise that can be put on the table that allows both parties to save face. But of course, we are up against the clock here. That June 1st theoretical deadline is looming quite large. And Speaker McCarthy yesterday pushed back on the idea of a short-term raise to the debt limit. So it's not that much time to work with, really just a matter of weeks, which is why President Biden also said yesterday he has considered alternatives like the 14th Amendment, though he seemed reluctant around that idea given the likely legal challenges that would follow. So it remains very unclear this morning, Lisa, really what the path forward is, what the compromise can look like. And obviously you're seeing those jitters showing up in the market with yields surging on 1-month T-bills.
Kayleigh, thank you so much. And just sticking with the D.C. Type of theme here, we are getting some headlines about the Republican Representative George Santos of New York, who was charged with fraud and money laundering. He was also charged with public fund theft and false statements. This coming out after a New York Post report earlier saying he would surrender to federal authorities in this. And this is one of 5 people who add to the majority that Kevin McCarthy has in the House. Morgan Stanley's Lisa Shallot has been delivering a warning for Wall Street. She's seeing growing threats to the economy, even if Congress avoids default. Take a listen.
It matters, to forward-looking expectations of growth in terms of what is cut. If that's what it takes to get a deal done, commitments to cut fiscal spending, what's cut? Are there rollbacks of some of the Inflation Reduction Act spending related opportunities, some of the infrastructure spending that is kind of in motion, and those things have been a support to growth. And if we need to, take that out of the forward forecasts, that is going to dampen economic growth.
Andrew Hollenhorst and Eric Knudsen still with us. Andrew, how much are you paying attention to the debt ceiling debate as potentially something that could seize up yields, but also for longer-term growth trajectories?
And so like everyone else, this is something that we're very focused on. And I think good news that a meeting was had. Not much came out of that meeting. Of course, expectations were very low going into it. So we're all just waiting. We're watching. At this point, what we're doing, and I think a lot of other observers, every day we are looking at the daily statement that comes out from the Treasury. We look at the inflows. We look at the outflows. We try to form our best projection of how far Treasury can go before there could be an issue with a payment. Of course, Treasury Secretary Yellen guided towards June 1st as the earliest date there might be an issue. When we look at our own forecast, we see that maybe they can get out further than that. Maybe they can get out to July. But absolutely, there could be an issue in early June. So this really is an issue that needs to be resolved in the next few weeks.
Going over that deadline, Andrew, is that bullish or bearish for Treasuries?
I think counterintuitively, in some ways, for longer-term Treasuries, you would probably see yields go lower. That's what we've seen in past debt ceiling episodes. Of course, in the very front end, you could have T-bill yields go higher, and we were already seeing that with some investors avoiding those T-bills. But at the end of the day, if we get into that type of a circumstance, investors are going to look for stability. And I guess the good news is that there would still be an expectation in the market that long-term Treasuries are a stable store of value.
Eric, your view, how closely are you watching this? What is your sort of response function should this really get to the brink?
Well, like everybody, we can't take our eyes off it, right? But we have no edge in being able to predict or forecast government negotiations amongst the parties. Our observation is that neither side has a strong incentive to kind of go over the brink, as it were. So I think, like most folks, we do expect some kind of deal to be made. It appears likely that the Treasury can manage things through the first part of June to get to the tax receipts that come in mid-June. But it's responsible of Treasury Secretary Yellen to highlight the June 1 deadline to put some pressure on the negotiations. What we do observe is that there's not much priced into equity markets on this. As Andrew pointed out, there is interesting stuff priced into the short end of the bond market. But this is just another one of the kind of elements that causes us to be cautious more broadly on equities and risky assets, given kind of the weight of some of these uncertainties and the current valuations of equity.
Eric, where are the places to hide within equities? What is considered a safe spot in stocks?
So we like lower beta within the U.S. We like lower beta, higher quality names. We want to be in the stocks that will do better in a high volatility environment once that volatility does start manifesting. And then, we've begun to increase exposures overseas, where we like Japan in particular as an equity market, where you have an opportunity to take advantage of valuation, where you're still getting some positive stimulus, where you're actually getting inflation and also benefiting from a cheap currency. You're close to China and reopening there, and you're also benefiting from some improving governance that we think is evolving towards better valuation, should add some additional premium in that market and parts of Asia as well from an emerging market standpoint.
Eric Knudsen, Andrew Hollenhorst, both of you, thank you so much for being with us today. Coming up, the morning calls and later, stay cautious and prepare for more volatility. That's the message from SoFi's Liz Young. We'll catch up with her around the opening bell. Right now, we are seeing a bit of a pop following perhaps a bit of a downside surprise, at least very much on the margins with CPI. This is Bloomberg. Countdown to the open. I'm Lisa Abramowitz in for Jonathan Ferro. Time now for our morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, Edward Jones downgrading PayPal to hold. The analyst removing shares from his focus list after reporting weaker than expected results. Next up, Piper Sandler upgrading Hain Celestial to neutral, saying lingering risks are now properly priced into shares. And finally, TD Cowen downgrading Nikola to market perform with a $1 price target, seeing a challenging macro environment with limited ability to raise capital. And we continue to see a very stock-by-stock, story-by-story type of sector, with Airbnb falling and yet Wynn gaining after reporting diverging earnings. Coming up, SoFi's head of investment strategy, Liz Young, joining us at the opening bell. That conversation coming up next, as we do see a lift after the CPI report came in pretty much in line with expectations. The NASDAQ, not surprisingly, leading the gains, 0.8% gain, 13,371, as people game out whether some of those rate-sensitive stocks could benefit from a Fed pause. And the S&P of about 0.7%. Yields a bit lower, particularly on the front end, 3.96%. This is Bloomberg. Countdown to the open. I'm Lisa Abramowitz in for Jonathan Ferro. Moments away from the start of the trading, that lift persisting into the open. NASDAQ up 0.8%. The S&P up about 0.7%. You can see the Russell really leading the charge, with small caps getting that bid in. We are seeing over in the yield space, yields in, and you can see the dollar a bit weaker. Stocks up, yields in, dollar stronger. Some perhaps a retracement of what we've seen in the oil space. And this is something that we keep talking about as we forward ahead to a time when perhaps we're moving more to stock picking and less to overall indexing. You can see crude $73.20. One stock that we're watching at the open is Airbnb. Shares sliding after the company delivered a weaker than expected outlook as the post-COVID travel rush loses steam. Bloomberg's Abigail Doolittle is back with us for more. Abigail.
And for a brief moment this morning on the open, which is just a matter of seconds, the stock was having its worst day ever since IPOing in 2020. Now looking at the worst day since November of last year. And what makes it so interesting, the first quarter that they reported was really pretty strong. They put up 20% revenue growth for $1.82 billion in revenue, Airbnb's best first quarter ever, as the pandemic trends continue to play through of people wanting to get back out there, working from home, creating those longer weekends. But it's that second quarter that you were talking about, Lisa, that has the stock down so much. The idea that some of these trends are muted. They're now looking for growth of 12 to 16%. So if you consider back in the fourth quarter of 2021, when revenue growth was closer to 80%, the last quarter, this first quarter, 20%. Now we're looking at somewhere between 12 to 16%. Investors want more growth. Now, when Brian Chesky, the CEO, last week joined us on Bloomberg Television, he was talking about the idea that if the economic uncertainty were to lift, that would help out. So perhaps some of that uncertainty will lift, although based on all of the headlines and the data that we're receiving, even given the fact that CPI print right now is in line, it's unclear, funny enough, whether or not the uncertainty will lift. So right now, this stock under pressure because of those lower growth expectations and travel expectations on the part of consumers.
Abigail, thank you so much. Sticking with earnings, Wynn Resorts posting a record quarter driven by a surge in business from Las Vegas. The CEO writing, quote, "Each of our resorts is generating strong financial results, a testament to our team's relentless focus on delivering five-star hospitality and experiences to our guests." Bloomberg's Katie Greifeld joining us now. And this really is the tale of two hospitality companies. Airbnb seeing really potentially negative trends there, but you see that positive kind of tone from Wynn. Katie, is this just a market-specific thing, or is this a very company-specific thing?
Looking like it's a little bit more company-specific, but I will say, even though it was a big quarter for Wynn, you wouldn't know it by looking at the shares this morning, currently down about 1%, even though, I mean, first quarter adjusted EPS, it clocked in at 29 cents. Analysts were expecting a loss, actually, of 9.2 cents, so a big beat there. Operating revenue also coming in better than expected, as did most of its occupancy stats. You brought up Las Vegas. Let's also talk about Macau. Hotel occupancy there was nearly 91% versus estimates of just 53%. You saw at least 3 analysts raise their price targets in the wake of these numbers, but still, even though Wynn was higher pre-market, we're looking at a little bit of a loss here as trading kicks off.
Katie, thank you so much for that. Turning now to the automakers, Rivian reporting a smaller than expected loss and reaffirmed plans to boost production, writing in a statement, quote, "While challenges remain, we have become a stronger, more agile company through this process." Joining us now is Bloomberg's David Welch in Detroit. David, how much of this is a story of just simply surviving a David versus the Goliath that is Tesla?
Oh, it kind of is. I mean, look, the smaller than expected loss, but they also spent less on CapEx, and they've been cost cutting. So it's not like the company is posting huge sales, but they are hanging in there. Cash balance over $11 billion in an environment where it's very tough to raise capital. That's a good sign. The biggest thing I think investors are reacting to in aftermarket yesterday and pre-market trading this morning is they're on target to deliver 50,000 vehicles. While that doesn't sound huge, you look at General Motors, they're going to deliver 70,000 of their new Ultium-based electric vehicles. So that's a pretty good number. And it's always been a problem for whether it's legacy automakers or startups getting EVs produced, getting them out the door. So they're getting production up. Long term, though, they're still going to have to afford to develop new models and boost production. A lot of that costs a lot of money. So when they say there are challenges ahead, there certainly are.
David Welch, thank you so much for that. Stocks are higher for the third time in the past 4 sessions. Lafayette's Krishna Mamani saying equities aren't a bad place to be.
In any tightening cycle, there is only one theme that lasts throughout the whole thing. And this go around, it's simple. Nominal growth is quite strong. It's coming down. It hasn't come down enough. And inflation was quite high. It is coming down. It hasn't come down enough. That's the regime that is going to be in place. And that's really not a bad regime for equity markets.
Well, perhaps not in the long term. Short term, however, SoFi's Liz Young telling investors to stay cautious, embrace for volatility. Liz joins us now. Liz, is that really where you start with? Basically, long term, maybe yes, but short term, it's going to be pretty rocky.
Yeah, I mean, for any long-term investor, you do have to have equities in the portfolio, and I'd be hard-pressed to find a time in my career where I would say that you don't have equities in the portfolio. However, we are in a period where there's a lot of signals going off that we're still late cycle in the economic behavior that's going on, which would tell you that If we do approach a recession later this year, markets rarely tend to bottom before the recession. So even if we have to retest some of those lows, it would tell me that there's volatility that's more likely than not. I think what investors are grappling with, self included, is that there hasn't been a ton of volatility this year already, even though we know all of this data. I think it's important that CPI is cooling, and I'm optimistic about the report today. And one of the questions that I get pretty often is, what would turn you from cautious to more optimistic? And the answer is always if services inflation comes down. And it has shown signs of weakening. I think we are on the right path. It's a matter of, do we get to the goal before something else breaks? And I'm not sure that that's something that we're going to see happen in the next 6 months or so.
Let's build on that. Morgan Stanley's Ellen Zentner seeing a potential Fed pivot, writing, quote, a slight increase in core inflation with significant deceleration on core services should encourage the Fed to keep the door open for a June hike. We continue to see the data and financial conditions firmly supporting a pause in June. Is that your view, too? That basically this is a green lighting a pause, the CPI data that we just got, and really just confirms some of the rate cuts that are being fully priced into the market now by September?
Yeah, look, the Federal Reserve doesn't call me for my opinion, and I know that they're doing a lot of different analysis on everything that they see out there. I think that they could justify a pause. And frankly, I think they could have justified a pause last time. It's a matter more of, do they want to stay consistent on their narrative that they wanted to get to a sufficiently restrictive level and then hold rates at that restrictive level for an extended period of time until the inflation problem is taken care of. We are sufficiently restrictive, in my opinion, and you can measure that a number of different ways. If you look at it as Fed funds rate above the 10-year Treasury, we can check that box. If you look at it as Fed funds rate above inflation, we can more or less check that box, as long as you're not looking at core CPI. But if you're using their measure of PCE, Fed funds rate is above that. So we're restrictive. They could pause here and use that as the explanation. They're seeing some cooling in the data. We think rates are restrictive enough. We want to wait for those long and variable legs to work their way through the economy. I think that's probably a fair statement to make. Frankly, I don't know how much of a difference 25 basis points makes at this point. I think what they probably have tried to avoid was too much of a rally or too much of a natural easing in financial conditions just because they paused. And there still continues to be this big disconnect between what the Fed is telling us they're going to do and what the market thinks they'll actually be able to do. One of them is going to be wrong by the end of the year, and we're going to have to see those expectations come closer to in line late summer, early fall.
Liz, you pointed to the idea of something breaking and how it's too soon to say that it's all clear in terms of a real financial market fissure or some other development that really calls the market's hand in a more significant way. Where is your focus in terms of the catalyst? Is it still on the regional banks? Is it on commercial real estate? Is it on private credit and debt markets that we have continued to see blossom, and people say that they're in a golden spot? How much are you looking at specific markets to understand the next shoe to drop?
Well, I think everything that you just named is not mutually exclusive, and I think it's all indicative of a tightening credit and tightening availability of funds. And just on a very simple level, if you take a bunch of funds and a bunch of movement of money out of the economy, there's going to be contractionary feels about it, right? There's going to be less money that moves around for consumers, less money that moves around for businesses. I think what's happening right now that we don't hear about or talk about very much to regular investors is that you're seeing a tightening of credit to small and mid-sized businesses. If those businesses are not publicly traded, or if we're not hearing about it from the companies that are tightening that credit, we're probably not getting the full picture. So I think that there are some stresses bubbling under the surface that just haven't quite made their way into the general narrative that we're seeing in publicly traded equities, for example. But there is definitely a tightening going on, and tightening in lending standards that's going to be experienced over the next 2 to 3 months. The question is, does that then translate into higher default rates? Does that then translate into what affects the consumer and consumer lending? Those are the questions that are not answered yet, but I do think we're going to see some stress that comes more into the mainstream from that tightening of credit, and that's where my focus is.
What's the best place to express that stress, given that a lot of people are expecting some sort of catalyst? A lot of people are staying away from certain equities and hiding in bonds.
Well, if you look at corporate bonds, some of the spreads are still too tight, in my opinion. I think you want to be careful not to get too optimistic on high yield bond spreads or even investment grade bond spreads, particularly in that BBB space, because if we do see credit stress, we're likely to see those spreads blow out a little bit more than what we've seen so far. So in equities, I still would be cautious, and I still would be looking at things like defensive sectors, although they're overpriced. But you want to be careful not to be overly exposed in this environment to things that would take it on the chin in a cyclical downturn. We've obviously already seen financials take it on the chin quite a bit. That doesn't mean that's over, but they have experienced quite a bit of a drawdown already. If you look at other things like industrials, even consumer discretionary to some degree, if we see this hit the consumer, you want to be careful in those places too. I still like short-term bonds. I think that these yields are really attractive, and they're yields that we haven't seen in such a long time and may not see again for a very long time. So I like that as a space. I like gold, even though it's hovering around all-time highs. I think it's there for a reason. And as the dollar weakens and we continue to see monetary policy change around the globe, I think gold is going to continue to catch a bid.
Liz Young, thank you so much for being with us. And just sort of to build on some of the caution, UAE's Royal Group shorts U.S. stocks, just coming out and saying that an investment firm controlled by a top Abu Dhabi royal has gone short U.S. stocks as it prepares for a recession. Coming up, the banks back in focus.
The Fed basically made interest rates very low for a very long time. They flooded the banking system with deposits. Some banks took those deposits and bought long-dated assets. That didn't work out for them. So the Fed Reserve's monetary policy did contribute to the problems that we've seen in the banking sector.
First Citizens providing some optimism. We'll take a closer look at some of the regionals with CFRA's Alexander Yoakum.
This is Bloomberg's The Open. I'm Lisa Mateo, live in the principal room. Coming up, Airbnb CEO Brian Chesky. That conversation at 1:30 p.m. Eastern and 6:30 p.m. in London. This is Bloomberg.
The Fed missed what was going to happen in the banking sector. If you look back at the November financial stability report, there was nothing about the potential funding risk of regional banks. There was nothing about the large mark-to-market losses on their balance sheet. There was nothing about the risk that uninsured depositors might leave. So the Fed really didn't capture that. And I give the Fed a lot of credit for the report that they published just recently on what went wrong with Silicon Valley Bank. I think they do recognize their supervisory failures, but that's not sufficient.
First Citizens giving the banking sector a dose of optimism, at least this morning. Deposits topping $140 billion in the wake of its rescue deal for Silicon Valley Bank. That acquisition adding nearly $10 billion to their net income. The CEO giving investors a bit of confidence, saying, quote, "We continue to operate with solid capital and liquidity positions." For more diving in is Katie Greifeld of Bloomberg, who is back with us. Katie.
Well, this was really fascinating because this was really the first look that we got at how First Citizens is faring after that rescue deal for Silicon Valley Bank back in late March. And so far, it looks pretty good. You can see that in the shares this morning. Like you said, First Citizens said that its deposits totaled $140 billion in the first 3 months of the year. Analysts, for context, were expecting about $119 billion. The SVB acquisition also added $9.8 billion in preliminary gains to its net income and about $850 million in net interest income to First Citizens first quarter. Now, remember, First Citizens bought about $72 billion of SVB's assets at a big discount of about $16.5 billion. That's been a big boom for shares, as you can see, that line in white there. They've just about doubled over the past 2 months, definitely adding to those gains today. Shares currently up about 9% or so.
Katie Greifeld, thank you so much. This hasn't necessarily brightened the optimism more broadly. CFRA's Alexander Yoakum painting an ugly picture of the sentiment surrounding regional banks, writing, quote, "Since the collapse of SVB, investors have been looking for the reasons to sell regional banks rather than reasons to buy them. We expect a meaningful decline in profitability for regional banks in Q2. Alexander, I am pleased to say, joins us right now. Is this really just a question, Alexander, of profitability, or is this a broader existential threat to their existence as smaller institutions at a time of rapidly rising rates?
Yeah, I think for most banks, it is just profitability. I think regional banks do serve an important purpose. You have to remember that, smaller businesses really do prefer the regional banks. They have more customized services that they like. But yeah, I mean, profitability is going to be tough with rising funding costs and slowing loan growth. Profitability is going to be, tough in Q2 and probably in the third and fourth quarter as well.
What's the response to it, Alexander? And what's the barrier to have a greater wave of consolidation that a lot of people are calling for?
Yeah, I mean, in terms of consolidation, we do expect some consolidation going forward. Especially for banks with excess deposits, we think they're going to be attractive. But like I said earlier, I mean, I do think banks of all sizes serve a purpose, and the U.S. is a little bit unique in that aspect, and I think that's a good thing, not a bad thing.
So, given the fact that they've been under pressure, Alexander, what's the read-through in terms of credit tightening that people are expecting, even if we're not yet seeing it in the Senior Loan Officer Opinion Survey?
Yeah. So in terms of loans and credit, we do expect loan growth to come down, especially for regional banks, banks with deposit outflows. We expect them to have even more, loan contraction. Business probably a little bit more than consumer. In terms of credit quality, credit quality is still very strong. The average regional bank, their credit quality is still a third stronger than it was pre-pandemic, and it's only 10%. So only 10% of loans are going bad compared to the great financial crisis. So in terms of credit quality, things are quite strong, but loan growth we do expect to slow down.
Do you have your eye on any banks that have particularly high concentrations of office-related commercial real estate, other assets that you think aren't properly hedged? Do you think that there are those other shoes to drop, or do you think people got ahead of themselves as they tried to play roulette with the regional banking wheel?
Yeah, I think they might have actually gotten a little ahead of themselves. You'll notice banks that do have high commercial real estate exposure actually did perform pretty well in the first quarter. What typically happens is, recessions are a surprise, and banks don't have time to react. But in this case, banks have been talking about a recession, for a year now. So they've had, generally time to prepare for this. They've increased their provisions for loan losses. They've increased their capital. So although credit quality will likely get worse, we actually think a majority of banks have prepared pretty well for that.
Do you feel like perhaps we're getting closer to a bid in this sector, or do you think that that's way too soon just simply because sentiment is driving the bus?
Yeah, so sentiment is driving the bus, but the positive is, I've only heard, negative headlines for the last month or so. So if we do start to get some more positive, results or news, I wouldn't be surprised if there was a pretty sharp rally. Whenever everybody is on the same side of the boat, if it flips, it could be a pretty quick surge. We saw a little bit of that with PacWest already, but I wouldn't be surprised if the whole industry, had a pretty good run on a positive news.
Just real quick, Alexander, what's your buy list, or what's on your buy list if that happens?
Yeah, so we definitely think that owning all regional banks right now is a little dangerous, just because banks that do have high levels of uninsured deposits or deposit outflows, there's concern there. But we think a name like PNC, which is actually the 6th largest bank in the U.S., is very well positioned. They've been grouped in a little bit with some of the other regional banks, but they actually didn't have deposit outflows in the first quarter. Over half of their deposits are insured, and they're very well diversified by geography. But they've sold off versus the larger banks, which are largely flat. So we think that's a little bit unfair on them. And then Fifth Third is another one that we really like. A little bit of a smaller name, kind of a classic regional bank there. But again, they didn't really see deposit outflows in the first quarter, almost 50% between consumer and commercial, well diversified. Both of those banks didn't really see net interest margin contraction, wasn't too substantial there. And, considering they've sold off pretty significantly, we think if they kind of perform as a little bit status quo, they'll likely outperform.
Alexander Yoakum, thank you so much for that. Let's take a look at some of the sector price action this morning and head over to Bloomberg's Abigail Doolittle. Abby.
And it's interesting, Lisa, because earlier on that CPI print, that inline CPI print, we had been looking at a gain of almost 1% for the S&P 500, now up just slightly. Just a few of the sectors higher. In particular, we have communication services, technology, and discretionary discretionary higher, but utilities leading the way up 0.8%. This is yields go lower, makes those dividends look more attractive. That's the case over the last week, too. Now, most sectors over the last 5 days are higher, but you'll note that two of these yield-sensitive, dividend-sensitive sectors, real estate and utilities, are sharply higher, and the financials, which could benefit from the idea that yields are going higher. Well, today, obviously, they're going lower, up about 0.5% as well. But it's interesting to see investors paying attention to this, for sure.
Very much so, Abigail. Thank you so much. Coming up, the market-moving events that you need to be watched. That's next in our trading diary as we do see that pop throughout markets more broadly. This is Bloomberg. This is Bloomberg's The Open. I'm Lisa Abramowitz in for Jonathan Ferro. Taking a look at markets, you are seeing that pop. We are going to be watching that throughout the day. The trading diary, what you need to be watching this week, the House Financial Services Committee holding a hearing on recent bank failures. That's at the top of the hour. President Biden discussing the debt ceiling at 1:30 Eastern. Tomorrow we'll get another U.S. PPI, another read on inflation, as well as, of course, jobless claims. And we round the week on Friday with more Fed speak. Jefferson, Bullard, and Daly all on deck. Plus, President Biden and congressional leaders once again meeting to talk about the debt limit. Right now, what we are seeing, Nasdaq up 0.7%, basically pulling back a little bit from earlier gains. This is Bloomberg.